What's up everybody, Gen X Dividend Investor here. In this episode I'm going to walk you through 9 strengths of quality dividend stocks that even the skeptics can't realistically refute. And to keep things balanced, I'll also break down the common counter-arguments critics would probably bring up so you get a well-rounded perspective. Now I'm speaking about quality dividend stocks in this video because there are crappy stocks with unsustainable and declining dividends, and all bets are off when it comes to those weak tickers. With that being said, the first strength I'll call out is that quality dividends enable predictable, stress-free passive income that grows faster than inflation, providing a reliable and increasing cash flow stream. I've been retired on good dividend stocks for almost 5 years now, and it's been as awesome as I hoped. Not only has my portfolio size increased, but my dividend income has grown faster than inflation as well, even with the big spikes from the pandemic. I've received about $520,000 in dividends since I retired, and I've used almost all of that to pay the bills. So yes, my dividends are paying the mortgage, our insurance, groceries, and all that jazz. I say almost because I reinvest a very small percentage of them to enable more growth. Now if you're new to my channel, then feel free to watch my recent videos where I showed you all my holdings in Fidelity and explained how I got to this point after investing for over 3 decades. A key point I want to get across is that I'm just some rando on the internet. There'll always be people with bigger portfolios than you and smaller ones, but that doesn't matter. Like I have some Patreons who have 8-figure accounts in US dollars, far eclipsing the few million bucks my portfolio is currently worth. I share that to emphasize that you shouldn't compare your realities to mine or anyone else's. Don't feel envious about what someone else might have, because while they might have a larger portfolio, you might have better health than them, or stronger relationships, or maybe a better World of Warcraft raider or whatever. What does matter is what you do from today going forward, and my portfolio or income shouldn't affect how you feel. Anyway, back to the strength. One of my favorite things about good dividend stocks is that they've provided me with predictable and stress-free passive income that has been trending up over time. The word passive is huge to me because literally doing nothing and yet still having money automatically deposited into my checking account has been as amazing as it sounds. Warren Buffett said that if you don't find a way to make money while you sleep, you'll work until you die, and that idea perfectly explains why quality dividend stocks are worth considering. They create passive income and help build long-term wealth without needing constant effort. I don't worry about whether dividend cash will show up in my checking account each month because I've built a strong and diverse basket of companies that I believe can handle market crashes and economic shocks. The truth is, a lot of them have already done exactly that, and they've done it for decades. Of course, nothing's guaranteed and dividends aren't a sure thing, but I feel confident enough in the strength of my businesses that I go to bed every night without stressing about whether my income will keep coming in. When I had 9-to-5 jobs and was relying on salaries, I was sometimes worried about being able to pay the mortgage, and that kind of stress really wears on you. So being in a place now where I don't carry that weight is something I truly reflect on and appreciate almost every day. That being said, my portfolio isn't without risk, but that's part of the reason why I own 28 tickers across different industries and sectors, including multiple ETFs. So quality dividends buy you time, calm your mind, and grow your future, all without you having to lift a finger. Now, one thing that some people don't realize is that dividends are real profits your company is transferring to you. Like Coca-Cola sells its sodas and then people like me buy them, all of which creates profits for Coke. Coke is the 17th largest position in my portfolio, and each quarter they transfer about $850 of their profits as dividends into my checking account. Specifically, they pay out 51 cents per share per quarter, or $2.04 per share per year. I have 1,666 shares of Coke, which would freak out my wife if she knew that number because she's superstitious, but I'm okay with it because I'm only a little stitious. And they've done a dividend hike for 63 consecutive years, which is longer than I've been alive. Like this past February, their hike increased their dividend by 5.2%, which is great. And then this tool from FastGraphs, which I'm an affiliate of, shows that Coca-Cola dividend increases have averaged an annualized rate of 4.75% over the past decade. That's nearly twice the average US inflation rate during the same period, based on data from Finder. So what does that actually mean for the buying power of my Coke dividends? Well, it means that even after accounting for inflation, my dividend income has increased by about 22.3% in real terms over the last 10 years. Or to put that another way, if my dividends could buy $1,000 worth of goods and services 10 years ago, they would now buy the equivalent of about $1,223 worth in today's dollars. That 22.3% gain reflects the real inflation-adjusted growth in my income. That kind of inflation-beating performance is one of the reasons I value dividend growth investing as a long-term income strategy. And the best part is that all of that happened without me lifting a finger. Sure, I had to work and save to invest in Coca-Cola years ago, but now I just sit back while they continue sharing a portion of their profits with me. Stocks go up and down, but dividends are something different. They're real transfers of company profits. That's cash landing in your account, not just paper wealth tied to a stock's price that only becomes real if you sell it. And that difference is important. Companies that consistently pay and grow their dividends often provide highly predictable income. That reliability is especially valuable during uncertain times, and once you've made the investment, the income continues to arrive, at least with good companies. There's no need to sell anything and no need to try to time the market. It's one of the few forms of income that is truly passive, and that simplicity is part of what makes them so powerful. That steady and rising income brings a real sense of calm. It helps reduce anxiety even when the market's bouncing around. So what would the critics say to all that? They would probably point out that no investment is completely stress-free, especially if a company decides to cut its dividend. And they're right, but when you focus on high-quality businesses with long track records of consistent payouts, the risk becomes much smaller. Stress is a relative term, but I can say that for me, and for many investors, buy and hold investing in quality dividend stocks is about as close to stress-free as investing can get. On the other hand, needing to sell stocks for income can definitely raise stress. It can be frustrating when the market jumps right after you sell, and it can be discouraging to know that you now own less of the asset than you did before. In fact, a study called Explaining Investor Preference for Cash Dividends, Sheffrin and Statman talk about the psychological comfort that comes from receiving dividends. They found that investors tend to feel significantly less stress when they live off the income from dividends instead of having to sell shares and dip into their principal. And again, I'm talking about investing in quality dividend payers, not speculative yield traps with declining NAV. Strong companies tend to avoid cutting dividends even during tough economic conditions. If you hold a diverse mix of quality dividend stocks, you're far less likely to see your income take a major hit from one individual cut. Diversification reduces both the risk of cuts and the impact when they do occur. Now, the naysayers might say that some dividend growth does not always keep up with inflation, especially during periods of sharp spikes. That can be true, but usually that only happens in the short term. The fact is that over longer periods, at least historically speaking, the data shows that dividend-paying companies have outpaced inflation on average over time. Like this article says that since 1940, dividends per share have grown an average of 2.4 percentage points faster than inflation each year, which is a significant margin. So sure, there have been times when inflation has outpaced dividend growth, but those periods usually have been brief. Long-term investors tend to look at a broader picture, not just isolated years. What matters is how dividend income performs over decades. And the bottom line is this. Most of the research on dividend growth rates show that they have consistently and materially outpaced inflation when measured over longer time frames. That's one of the key reasons why dividend growth investing remains such a powerful long-term strategy. Moving on, let's jump to strength number 2, which is that selling shares for income reduces how much of a company you own and lowers your future compounding potential, while dividends preserve ownership and enable ongoing capital appreciation alongside future income growth. Or to put it simply, when you sell shares for income, you end up owning less of the company. That reduces your share of any future growth and profits. But with dividends, you receive income without giving up ownership. Your full position stays intact, which means your investment can continue to grow and your income has the potential to increase over time. Now, some critics argued that dividends don't matter because a stock's price drops by the amount of the dividend on the ex-dividend date, but they often overlook the fact that selling shares reduces your ownership while dividends do not. And another thing they often don't mention is that when a company pays a dividend, its stock price usually drops by around 80 to 90% of the dividend amount on the ex-dividend date. This is a well-documented pattern known as the ex-dividend date anomaly, and experts aren't entirely sure why it happens, but common explanations include investor preferences for dividend-paying stocks and certain tax-related behaviors. The more important point, at least in my view, is that dividends give you income while preserving your full claim on the company's future. You continue to own the same number of shares, which means you still benefit from any future gains in income. As the saying goes, dividends pay you without shrinking your claim to tomorrow's growth. Once you sell shares, they're no longer working for you. But with dividends, you receive income today while still participating in the long-term growth of the business. Let's look at a quick example to highlight some of what I'm talking about using a ticker I own in Coca-Cola. FastGraphs shows me that there are about 4.3 billion shares of Coke, and it trades for about $70 a share as I'm working on this part of the video, which means it's worth about $300 billion. So my 1,666 shares of Coke divided by 4.3 billion shares total means I own 0.0000039% of Coca-Cola. They pay a dividend of 51 cents per quarter or $2.04 per share per year. That means I get 1,666 multiplied by $2.04 per share, which is $3,398 per year of Coke dividends. Not bad, but it's nothing compared to Buffett's Berkshire Hathaway, who has 400 million shares of Coke, which means that they'll get paid $816 million in Coke dividends this year with their 9.3% ownership stake in the company. Hearing of successful investors like that keeps me motivated to what's possible over time. Anyway, before my Coke dividend payout, I owned 0.0000039% of the company, and after the payment, I still own 0.0000039%. Even after a full year of dividend payouts, my ownership stays the same, assuming nothing else changes. But compare that to what happens if Coke didn't pay a dividend and I needed income. That means I'd have to sell shares. Right now it trades at $70 a share, so I'd need to sell 48.5 shares of it in order to get my $3,398 of annual dividend income. If I did sell 48.5 shares, then instead of having 1,666, I'd have 1,617.5 shares, which means I'd then own 0.0000376% of the company. Now, the naysayers would say that doesn't matter because with dividends, while you'd not be selling any shares, you'd still end up owning the same amount of the company, but it would simply be a company that's worth a tiny bit less. What they probably wouldn't mention is that you face a bigger risk of running out of your portfolio if you're constantly selling it. Selling shares is kind of like doing the 4% retirement rule, which often works in retirement, but still has more risk than I prefer. That being said, I'd wager that the far majority of people will have to sell at least some of their shares in retirement, and that's okay, and in fact it's awesome that they have some shares to sell. But my goal is to try to avoid selling if possible, and selling shares weakens your compounding potential. Now, at first glance, you might think I'm only talking about reinvested dividends, but this also applies to non-dividend stocks. I mean, even if a stock doesn't pay dividends, it can still grow through capital appreciation. And the more shares you hold and the longer you hold them, the stronger the compounding effect becomes. When you sell part or all of your position, you may lock in gains, but you also reduce the base that the future growth compounds on. That means less growth going forward. For example, imagine you own 100 shares of a company at $10 per share that grows at 15% per year. After 10 years, your investment would be worth about $4,045. But if you held for 20 years, it could grow to $16,366. And that's the power of compounding. The longer you hold, the more it accelerates. But if you sold some shares, let's say half your shares after 10 years, then you'd only be compounding on 50 shares for the next decade. That decision cuts deeply into your future gains because compounding is exponential, not linear. The biggest rewards come in the later years, and interrupting that process by selling too soon can seriously limit your long-term growth. So whether you're not reinvesting your dividends or selling your shares for income, both of those actions can slow down your compounding growth. You're reducing the amount of capital that is still working for you, and over time that really makes a difference. One of the final points critics often raise is that total return is the only thing that really matters. If growth stocks end up producing higher total returns, they argue that everything else is just a distraction, and that's a fair point. Total return does count, but there's also a trade-off. Selling shares to generate income adds more risk. It puts pressure on you to sell at the right time, and that doesn't always happen. And I've seen people exit their portfolios too early and miss the long-term gains they were aiming for. And you can always sell fewer shares as your portfolio shrinks, or adjust your approach over time, but to me that introduces more uncertainty and makes it harder to plan. Quality dividend income offers more stable and consistent experience. It supports both financial confidence and peace of mind, which can make a big difference in quality of life. So I'm not saying ignore total returns, but factor it into what you do. Other core points critics might bring up is that selling shares for income is more tax efficient, and growth stocks reinvest profits better anyway, and those are fair points in certain situations. I mean, selling shares for income can offer more favorable tax treatment, especially if you're in a low capital gains bracket or if you're timing your sales to defer taxes. But that doesn't automatically make it better in practice. I mean, dividend taxes can often be reduced or avoided altogether when dividend stocks are held in tax advantage accounts like IRAs, which neutralizes much of the tax difference for long-term investors. And if you're forced to sell shares during a downturn for income, you may still owe taxes and also lock in losses, which can hurt more than any tax benefits help. Dividends provide a steady stream of income without having to make those timing decisions. Even if they are taxed each year, many investors see the trade-off as worth it for the simplicity, consistency, and lack of withdrawal guesswork. So yes, capital gains may have tax advantages on paper, but real-life investing involves more than just tax rates. Now beyond taxes, let's talk about reinvestment. So while non-dividend growth companies often reinvest most of their profits, that doesn't automatically mean they do it better or more efficiently than companies that pay dividends. In fact, a consistent dividend policy can be a sign of disciplined management. It often suggests they choose to reinvest only when there are productive opportunities and return excess cash to shareholders when there aren't. This approach can help prevent poor decisions, such as large acquisitions that don't create value or internal projects that deliver weak returns. In that sense, dividend payers may actually reflect stronger capital discipline, not weaker growth potential. Moving on, the third strength I'll call out is that quality dividends can return your full investment and continue to deliver cash, potentially forever, effectively making your initial capital a self-renewing asset. What I mean is that over time, the total dividends you receive from high-quality companies can eventually repay your original investment. Once that happens, you're still holding the asset, but it continues to generate income without needing any additional capital from you. It turns your investment into something like a self-sustaining cash machine. You get your money back and the income keeps coming in. It's a bit like playing with house money. Imagine you go to a casino planning to play blackjack with $200 and you tell yourself that if you lose it, you'll walk away. But then you hit a lucky streak and double your money. Now you can set aside your original $200 and continue playing with extra money you made. If you lose, you break even. If you win, you come out ahead. Dividends can kind of work the same way. Once you've received enough income to recover your initial investment, everything after that becomes ongoing profit without ongoing risk. You keep collecting income without having to sell your shares or give up any ownership. And again, critics might say that no company pays forever, dividends can get cut or go away. They could also say it takes decades to reach break-even through dividends. My counter to their counter would be that nobody is saying it happens overnight. But with time, with reinvestment in the right companies, this model works. That's exactly what long-term investing can do. Moving on, the fourth strength is that reinvested dividends automatically increase ownership and accelerate wealth building through compounding without additional external cash. The fact is that reinvestment turns passive income into exponential growth. Every dividend you reinvest increases your share count. That usually means you receive even more dividends next time as things snowball. And this happens without needing to add more of your own external money. The investment funds itself and its ongoing growth. Reinvesting also averages your cost basis over time, which helps smooth out market highs and lows. And critics might say you still pay tax on dividends even if you reinvest them. And they might say that automatic reinvestment buys at bad prices. My counter would be that's true, dividends are taxable, but so is almost every form of investment income. That doesn't make it bad, it just means you plan accordingly. As for price timing, reinvestment often works best over time. Trying to time every reinvestment can do more harm than good. Okay, my fifth strength is that dividends often enable a long-term buy and hold investor mindset, fostering patience and reducing the impulse to react to short-term market volatility. Dividends play a powerful role in helping investors stay patient and committed to a long-term strategy. Instead of relying only on stock price increases, dividend-paying companies provide regular, tangible income. That steady cash flow gives investors a sense of progress even when the market is flat or even falling. It creates psychological stability. Rather than focusing on price swings, investors are reminded that their portfolio is still working for them. This can help shift attention away from short-term volatility and toward the actual business behind the stock. And the data shows that dividend-paying companies are often larger, more stable, and financially disciplined. Their stock prices tend to fluctuate less, which makes it easier for investors to stay the course. In fact, Fuller and Goldstein, writing in the Journal of Corporate Finance, found that dividend-paying stocks outperform non-payers by 1 to 2% more per month during market downturns. That kind of performance helps investors remain confident while others might be selling. Of course, critics argue that dividends don't stop people from panic selling, and that's a fair point. Dividends don't erase human behavior, and some investors will still chase high yields or make emotional trading decisions. But dividends do help. They offer a reason to stay invested. Sheffrin and Statman explained that regular dividend income serves as a psychological anchor. Investors often treat dividends as a separate stream of income rather than part of their investment principle. That's not necessarily good, but it often reduces the urge to sell during periods of market stress. And then this study by Tahar and Al-Shaboul also supports this. These guys found that higher dividend payments are linked to reduced trading activity, which means investors are more likely to hold their positions. So while dividends are not a perfect solution for everything, and they won't eliminate fear or remove risk entirely, they are still often a positive behavioral tool. I mean, when you continue receiving income from your investments, you're more likely to stay calm and hold on. And over time, that kind of patience can make all the difference. Okay, now I'll shift to the sixth strength, which is that long-term dividends are often a sign of a business that lasts and has robust financials, strong cash flow generation, and disciplined management. The fact is that long-term dividends are a good sign of a business that has had real staying power. Companies that consistently pay and grow their dividends for decades aren't just getting lucky. They show you that they have durable profits, strong cash flow, and disciplined leadership that knows how to manage capital wisely. Maintaining a dividend through recessions, industry shifts, and evolving technology takes more than confidence. It takes real financial strength. And the research backs those points up, like I already mentioned in the Fuller and Goldstein article. That kind of resilience says a lot about the quality underneath. A sustained dividend policy also tells you something about the people running the business. It signals that management is disciplined, focused on shareholders, and confident in the company's future earnings. Myers and Majlouf, or however you pronounce it, wrote an article about how dividends can act as a credible signal of a firm's underlying strength, since only companies with real financial stability can afford to commit to long-term payouts. Of course, not every company that pays a dividend is a high-quality business, and some critics point out that certain firms use unsustainable dividends to attract investors, which can turn into traps. Others argue that mature dividend payers offer slower growth. And all that's fair, though that's where you gotta do your own homework. The goal isn't to chase high yields, but to look for consistent rising dividends that are backed by strong fundamentals. And a long dividend track record is a good sign, but it's not an absolute. As Robert Shiller discussed in Irrational Exuberance, time filters out noise. Long-term dividend growth is a real marker of enduring business strength. But again, you can find edge cases where long-term dividend-paying companies end up cutting their dividend, or worse, so you need to look beyond the dividend and into the company's financial trends, its competitors, the industry, etc. Moving on, strength number 7 is that quality dividends often provide downside risk mitigation by returning cash even in weak markets or business declines, offering a crucial source of liquidity and tangible return when capital gains are absent. The fact is that one of the key strengths of quality dividend-paying stocks is their ability to help reduce downside risk. In weak markets or during business downturns, dividends return real cash to investors. This offers a crucial source of liquidity and a tangible return when capital gains aren't present. When stock prices decline or remain stagnant, the steady flow of dividend income acts as a cushion. This reliable income helps offset unrealized losses and supports investors through volatile periods without requiring them to sell shares at a loss. It's especially valuable for those needing funds for expenses or wishing to stay invested during uncertain times. So a dividend income stream creates valuable flexibility. Investors can reinvest dividends at more attractive prices during downturns. This can potentially lead to stronger long-term gains once markets recover. Bottom line, data consistently supports the protective role of dividends during challenging periods, and the worse the market does, the more of a return dividends often provide. Like in the lost decade where stock appreciation went nowhere, dividends were the only source of return for many folks, and the best companies kept raising them even in difficult times. For example, during the 2008 financial crisis, companies I'm long in like Procter & Gamble, Johnson & Johnson, and Coca-Cola continued to raise their dividends while many others were cutting back. So quality dividends don't remove all risk, but they do offer a meaningful layer of support. They provide dependable cash flow when it's most needed and can reduce the pressure to make emotionally driven decisions. The income can be a stabilizing force for investors, helping them remain patient and focused during periods of market stress. Moving on, a somewhat related strength is number 8, which is that quality dividend stocks tend to exhibit lower volatility, offering a smoother investment ride, and historically demonstrate greater resilience during market downturns. Part of Fuller and Goldstein's conclusions included that dividend stocks tend to have lower volatility. Dividend companies often operate in naturally stable sectors such as consumer staples, utilities, or healthcare, where demand remains steady and cash flows are consistent. That kind of business stability often translates directly into less dramatic price swings. And because these stocks move less dramatically, it becomes more easy for investors to stay calm and stick to the long-term plans, even when broader markets are in turmoil. An interesting study from Arnaud and Asnes found that the firms with higher dividend payouts, which often overlap with lower volatility profiles, tend to show stronger long-term performance. This supports broader evidence around the low volatility anomaly, where stocks with more stable price behavior often deliver better returns when adjusted for risk. So basically, steady and consistent performance, particularly when considered in the context of risk taken, can outperform more aggressive and volatile strategies over the long run. Now, critics fairly point out that dividend stocks are not immune from losses, and in strong bull markets, they may lag behind high-growth tech companies. But I think that misses the core value prop. The goal of dividend investing is not to chase the biggest immediate gain. It's about consistency, durability, and the compounding power of reliable returns. And an important benefit of lower volatility is actually psychological. It reduces the pressure to make fear-based emotional decisions when the market becomes unstable. For many investors, staying invested through difficult periods is the hardest part of achieving long-term success. The steadier price behavior of quality dividend stocks help provide the emotional stability needed to remain disciplined and participate fully in the market's eventual recovery. And with that, I'll end with my final strength, which is that dividend stocks have outperformed non-dividend stocks over time. Dividend-paying stocks have shown a consistent and compelling track record of outperforming non-dividend payers over the long term, which makes them a foundational element in a resilient, long-lasting investment portfolio. Their performance advantage comes not only from price appreciation, but also from the steady income dividends provide and the powerful compounding effect of reinvesting that income over time. Research from Hartford funds found that companies which grow or initiate dividends have delivered the highest returns among equities since 1973. And data shows that since 1960, approximately 85% of the cumulative total return of the S&P 500 can be attributed to reinvested dividends and the compounding that follows. Beyond return potential, a dividend-focused strategy often offers a steadier investment experience with fewer sharper swings in performance. So a consistent dividend approach helps investors build wealth not only through compounding, but also by fostering the discipline needed to stay invested through different market environments. And again, over time, that steady mindset has proven to be one of the most valuable returns any investor can achieve. And with that, I'd like to request that you do 2 things. Number 1, leave me a comment and tell me what's your favorite thing about dividend stocks. And number 2, please show your support by hitting that thumbs up button, subscribing if you haven't yet, and click that bell notification. Now I'd like to shout out my newest Patreon aristocrats, so thank you Christian for signing up. Next I'm going to shout out my 5 Gold Star channel members, i.e. the ones that have been members for a year or more. So thank you Brett Cherry, Truth, Scott Goodwin, Steve Doxa, and Keithman 5000. Moving on, now I'd like to show my gratitude to subscribers who've left me really nice comments. I'm going to shout out 10 who've done just that. So thank yous go out to Ben Herzl 8414, Sed's Dividends, Robert P. 1006, Artur Privit 8180, Nuno Fontes 3895, C. Mural, Whistler Brooks, and then multiple nice comments from the Gordy Pig, and multiple from Michael Swami, and multiple from Darius Z8N. Thanks, I really appreciate it. Now I'd like to recommend that people check out my Seeking Alpha affiliate link, which often has a discount when new users sign up. Next, I'll pitch my FastGraphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment, even if they sign up for a full year. Also check out my Patreon page, and or consider joining my channel membership, as both have some cool perks you might like. Finally, I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 Dividend investors on it from 86 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.